But did you know who governs the company? Maybe you didn't know, and we can try to bring that particular element here. We try to see who runs the company, how do we govern the company. That is going to be on this particular chart. So look at this chart here and tell me whether you do understand. The most powerful person in a company, as far as we are concerned, is the shareholder. The shareholder works with a group of people called the board of directors. The board of directors employ a person in a company called MD. Some people call him managing director, but we are going to call him chief executive officer. The chief executive officer is supposed to be different from another guy called the chairman. The chairman of the board. The chairman of the board and the CEO are always independent people and distinct from each other with different lines of responsibilities. The board of directors cannot work alone. In most cases, we say they appoint a number of committees to help them. One such committee is referred to as the appointment committee. Appointment committee. If you want to ensure good governance in a company, the rule is very simple. Employ a CEO, a director, a chairman who is free from influence from the others, or who is not related to this company if we want that company to be run in the best way possible. Did you know that a company, we have a small committee called remuneration that's supposed to be fixing remuneration of the what? The senior employees and employees in the company, including the management. We don't want a scenario whereby people are fixing themselves hefty salaries at the expense of the shareholders. And that's why we appoint a small group called Remuneration Committee. But there is another committee which is very, very crucial, referred to as an audit committee. And that is why earlier on we had agreed that we are going to be working on 3 topics. 1, audit committee, corporate governance, together with internal audit. The internal audit department is supposed to be established from what we refer to as the audit committee. There we have internal audit. And the purpose of internal audit is majorly to look on the internal control system, another topic we are going to be looking at very soon, internal control system. And there is also the case of the accounting system of an organization. Accounting system of an organization. Accounting system. If you go to an organization and you are employed there, they form most people that we say they are very, very superior. One of them is what we call the marketing manager. The other one is called the production manager. The other one is called the financial manager. And lastly, we have the human resource manager. So this guy we call the CEO has to work hand in hand with these particular lines of management. In most cases, we say this line here defines the management of an entity, whereas these lines here defines the directors of an entity. Directors of an entity. Both the directors and the management forms what we refer to as those charged with governance. The shareholders, the directors, and the management have a form of a relationship referred to as corporate governance, and that brings another definition. So if you wanted to define this term again, you will say it is a set of relationship. A set of relationship between directors, comma, managers, comma, shareholders, and other stakeholders. Shareholders and other stakeholders. So that whole set of relationship, the lines of reporting, the authority, the delegation. That whole system is called corporate governance. Now I hope you understand the corporate governance, because this is how we govern the company. We want to make sure that nobody is above the other, nobody is not being monitored by the other. We have people who are overseeing others, and that is very, very important. So the whole concept of corporate governance is about running the company in the best way possible, in such a way that the shareholders are going to enjoy the benefit of starting that company. We want to act on behalf of the shareholders of the company and not on our own behalf. And that is the whole idea. But this diagram here brings what we refer to as the code of corporate governance. The code means the principles that each and every person who has a company is supposed to be guided with. Something else you need to note about corporate governance is that, one, it is a requirement for all listed companies. So as long as you are listed, alternatively, you are awaiting to be listed, or you just want good governance in your company, then make sure you are using what? Corporate governance rules. It helps because apart from ensuring transparency, corporate governance also ensures accountability. And apart from accountability, we say it helps in ensuring fairness between shareholders, stakeholders, directors, and management. So fairness. And one other objective associated with this particular corporate governance is what we refer to as responsibility. It ensures people are responsible. With that kind of a framework, we can be able to know which area has failed the company, which area has been more strong. We can be able to know transparency is in which particular side and which area maybe is not accountable. We can talk about fairness, we can talk about responsibility based on that particular diagram. So we say these are the most four concepts of maybe corporate governance that you need to note. That is transparency, accountability, fairness, and responsibility. And those are the main reasons why most of the companies will go ahead and indulge themselves in introducing corporate governance in their company. Now, we need to discuss that thing called code on corporate governance. The code is principles, the principles of good governance in your company. And that code of good governance is going to be derived from that particular diagram. Let's see. If you want to run your company in the best way possible, that is going maybe to assist the shareholders get their what? Get the return or get the investment return that they were intending to get, then rule number one is that each and every company code on corporate governance. That's what we are looking at. Corporate governance. Every company should be headed by a board of directors. Every company should be headed by the board of directors. That is rule number one for every company. Don't allow the company to be run like a what? Like a shop, like maybe a case of a music store whereby, or maybe a music band whereby we have one person who is the soloist and maybe he's the same person who is playing the guitar. That will be presenting a major problem. So ensure we have the board of directors in a company. That is rule number one. And the board of directors should be separate from the shareholders. Board of directors separate from shareholders. I think you have heard of the situation what we call separation of powers and ownership, or separation of controls and ownership. The owners are the shareholders. The people who are controlling are called what? The directors. It's very good we separate that one. Number two, the board of directors should comprise of executive and non-executive directors. Board of directors should comprise of 1. Executive directors, 2. Non-executive directors. That is what we say. We have those people who run the company on a daily basis. And then we have those people who are supposed maybe to be overseeing the running of the company. That's what we bring in this particular case here. So you say the executive directors, if you remember in taxation, we sometimes refer to them as whole-time service director. Then we have non-executive directors, if you remember, we refer to them as the non-whole-time service director. These peoples are very, very crucial. Rule number 3, we say the number of executive directors should equal the number of non-executive directors less the chairman. So without counting the chairman, in most cases we say the reason for this is like whenever we go to the board meetings and perhaps we are discussing things and we are passing resolution, and we don't want a situation whereby one department is dominating than the other. We don't want an executive director to dominate than executive director, or executive director to dominate maybe non-executive directors. So for good governance, we should have a tie. We should have this one and this one equaling each other. But whenever we also have a tie when voting, automatically the reason why we are putting the chairman aside is because the chairman should break that particular tie. If we have 4 directors and 4 maybe non-executive directors, 4 executive, 4 non-executive, then it means if they are going to maybe fight because they cannot pass a resolution, now that 4 are opposing and 4 are proposing for that particular resolution, then we can even go ahead and ask the chairman, because he is the middleman here, to go ahead and support one side and pass that resolution if it is maybe beneficial to the company. So the reason why we don't count the chairman here is to make sure that that particular chairman can break the tie whenever it arises in a company. Number 4, we say the chairman of the board, to be distinct from, of the board to be distinct from the CEO, Chief Executive Officer. If we give the chairman the responsibility of running the company and we give him the responsibility of chairing the board, he will dominate. That's what we want to avoid. We want fairness and we want accountability. We want transparency and we want responsibility. And we cannot do that if one person is dominating it and each and every particular area. So it's very, very important that we have the chairman as a separate person, the CEO being a separate person, and each and every person should have a lines of reporting. Then we can also bring the case of committees that we should establish. What do you think we are supposed to establish? We establish 1, a remuneration committee. We establish 2, an audit committee. We establish 3, the appointment committee. Have you ever heard of a situation whereby a company is run by like a family? Sometimes it becomes as if it's a family business.